Hello and welcome to Weekend Wisdom. Today we're going to talk about, is consumer confidence just a big con? So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget to subscribe to our channel. Also below, show more links to articles from today's video, as well as information on how to contact me, and also access to my calendar. So the consumer, everyone is excited because we got this big read last week on consumer sentiment. Have not seen a number like this since 2004. Also, you look at this chart, we have the S&P on the top. This comes from John Lyons on Twitter. And below, the question was, do you expect the stock market to be up higher 1 year ago from today? Well, look at that number. Another great read, over 60%. And yes, the last time we had that, of course, was pre-crash. So some of this looks a little bit fishy. So let's dig in a little bit deeper to some of the numbers. Well, first up, household income. Not good. We've been flat since 1998. I just was talking to a client recently who works in the healthcare sector, without a doubt. Okay, next, debt. Look at this article. We are swimming in debt, okay? Here is the chart for debt right now, all-time high. Next one, student debt. Of course, that's gotten real ugly. Have my first going to college next year, understand that one. Okay, how about home ownership? Well, home ownership has really crashed since the crash, really since 2000. The younger generation are not buying. We're seeing rental prices soar. Yeah, we had a little bump recently, but not even close to where we were back in 2000s. Personal savings rate. Again, another trend is not your friend here. Where you look, it's going straight down. You look at the past, as we get to this levels, this is where we have seen some previous recessions from 2000 and 2008. Well, it's all coming from what? The wealth inequality problem. Look at this chart here. You have your lower class, working class, and middle class, 1998 to today. And everybody has lost some income in this group, except the other group. The top 10%, of course, and they have surged. So there is a definitive problem here. And again, this consumer sentiment report, I'm not sure who they're calling, but it seems a little skewed. Here's a quick little video that came from Financial Times, and we'll show you that, yes, we have seen an inequality of income. All right, and also we're going to break it down by state as well. So is it any different from 1998? Not really. You look at the chart here, 4.5% unemployment, we're at 4.7 today. Participation rate has gone down. Inflation a little bit lower. How about the government debt? Oh, just a smooth 5.2 trillion today. Of course, we just went over $20 trillion, having problems with the trillions today. So next up, how about shopping? Who's buying anymore? The death of them all. Here's just a few headlines saying just that, and the one stating what we know from the last slide, unless you're rich. So the consumer, what are they buying? Here is consumer staples. We just had a death cross, our 50-day moving average going below our 200-day moving average. Consumer staples are just that. The staples of what we use every day. Toothpaste, shampoo, underarm deodorant, etc. Right? People are out shopping for bargains right now, and they're not looking to buy high-end items unless, you guessed it, the rich. Consumer discretion, high-end items, higher-end cars, jewelry, other nice TVs, etc. Consumer discretion has been in a bullish trend all year. Yeah, we had a little bit of a pullback recently, but have a nice bullish flag, and we're working our way back up. And also at the bottom, we've got momentum, and it's pointing up. So yes, consumer discretion looks good. Staples, not good at all. So you take all of that information today. I mean, the consumer's not saving. They're not spending, right? They have more debt than they've ever had. This is a problem, and to me, I'm going to call that a contrarian chart because it doesn't make sense. I'm going to follow it up and finish it right here. How does it affect the markets? Here we are. The black line is the S&P. Of course, we're at all-time highs. Now, the average PE ratio is 15. If that were the case, we'd be at 1560 here. You can see the blue line. If we're at just 20, we'd be at 2080 on the S&P. And if we got oversold, 1040 would be the number. So consumers not spending, they're not saving, and markets are way, way stretched. What does it mean? Watch our weekly video. We talk about this all the time. Sure, we are invested, but I gotta tell you, this is really getting stretched. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.